The bullish harami occurs after a downtrend and is characterized by a large bearish candlestick followed by a small bullish candlestick. The bearish harami occurs after an uptrend and is characterized by a large bullish candlestick followed by a small bearish candlestick. To confirm the harami pattern, traders should wait for a third candlestick to close above the high or below the low of the harami candle. This third candlestick confirms the trend reversal, and traders can use this as an entry point for their trades. To enter a short or long position at the end of confirmation candle. Don't forget to subscribe my channel for more price action videos. Ready to elevate your forex trading game? Register with XM Broker using our exclusive link in the description and gain free access to our premium forex trading signals and analysis, a paid service normally reserved for our clients. Take advantage of this limited time offer and join the world of successful traders with XM Broker today. The piercing line is a bullish to candlestick pattern that occurs after a downtrend. It's characterized by a large bearish candlestick followed by a large bullish candlestick that closes above the midpoint of the first candlestick. The pattern signals a potential trend reversal, as the second candlestick shows that buyers have entered the market and are pushing prices up. Traders can use the piercing line pattern to identify potential buying opportunities. They can enter a long position when the third candlestick closes above the high of the second candlestick. Stop-loss orders can be placed below the low of the first candlestick to manage risk. The Dragonfly doji is a popular candlestick pattern used by technical analysts to identify potential trend reversals. It is formed when the opening and closing price are at or near the high of the trading session, with a long lower shadow and no upper shadow. This creates a shape resembling a dragonfly, hence the name. The Dragonfly doji indicates that sellers dominated the market early in the trading session, pushing prices lower, but buyers then stepped in and drove prices back up to close near the session high. This shows a shift in momentum from bearish to bullish and can suggest that a reversal in trend is imminent. The three black crows is a bearish candlestick pattern that consists of three consecutive long black or red candlesticks with low closing prices. This pattern is a strong signal that a bearish trend is forming, and it's often seen as a reliable indicator of a trend reversal. The pattern suggests that the bears are in control of the market, and they are pushing prices lower. The three long black candlesticks indicate that selling pressure is increasing, and buyers are losing control. Traders can use the three black crows pattern to identify potential selling opportunities. They can enter a short position when the fourth candlestick opens below the low of the third candlestick. Stop-loss orders can be placed above the high of the third candlestick to manage risk. The three white soldiers is a bullish candlestick pattern that consists of three consecutive long white candlesticks with higher closing prices. This pattern is a strong signal that a bullish trend is forming, and it's often seen as a reliable indicator of a trend reversal. The pattern suggests that the bulls are in control of the market, and they are pushing prices higher. The three long white candlesticks indicate that buying pressure is increasing, and sellers are losing control. Traders can use the three white soldiers pattern to identify potential buying opportunities. They can enter a long position when the fourth candlestick opens above the high of the third candlestick. Stop-loss orders can be placed below the low of the third candlestick to manage risk. The bullish belt hold line pattern is a bullish candlestick pattern that occurs in a downtrend. It is characterized by a long white candlestick that opens at or near the low of the day and closes near the high of the day, without any shadow or wick on the lower end. This pattern signifies a bullish reversal and suggests that buyers have taken control of the market from the sellers. Traders can use the bullish belt hold line pattern to identify potential buying opportunities in a downtrend. They can enter a long position when the next candlestick opens above the high of the belt hold line candlestick. Stop-loss orders can be placed below the low of the belt hold line candlestick to manage risk. Don't forget to subscribe and join our Telegram channel for latest news and analysis.